For more on the markets now, we're joined by Sam Stovall. He is Chief Investment Strategist at CFRA Research. Sam, thanks very much for joining us.
Happy to be here, Roger.
Another roller coaster today on the markets, but your thoughts on it? Is it short term? Are we looking for a good finish to the year?
I think it's short term. Basically, we've had a nice run since we got back to break even from the 19% decline earlier in the year. We advanced 11.5% over a 4-month period, which is typically what happens in that post-recovery period. So with us slipping into a potential decline of 5% or more, I don't really see as that big of a deal. And I think that could end up making for a nice jumping board into December's activity.
What gives you reason for confidence right now?
Well, I think that we are going to see some employment data on Thursday that will indicate that the Fed is likely to cut interest rates when they meet in December. I don't think it's going to be enough to cause investors to feel that a recession is imminent, but certainly it implies that the labor market continues to weaken, and so the Fed is needed to be proactive, and so that's what I think they're going to do. Also, with Wednesday's earnings report for NVIDIA, our expectation is that will come in stronger than what the street is anticipating.
And what's giving you reason for that?
Well, our analyst, Angelo Zeno, is looking for at least $1 billion more than the street is expecting in terms of revenue. So looking for $55.8 billion. Earnings are likely to be at $1.29 versus the street's $1.25. And also expecting good guidance for the January quarter. And we also believe that what's making us feel this way is that the positive tone that we expect to hear from the CEO, Jensen Huang, given recent hyperscaler comments and the $500 billion backlog cited at the recent GTC.
Do you think that will be enough for people? I mean, it feels like everything is resting on NVIDIA right now.
Well, we think it will. We've got to get some guidance also that implies that the trend is also likely to remain upward. Our expectation is that we could see at least $61 billion in revenues in the January quarter and $1.42 in earnings, which we believe is attainable. And so that could offer at least support, if not give reasons for a turnaround for this tech slide.
Now, on the other side, we saw Home Depot's earnings today. They are paying a price right now for it. Any concerns about that? And also the fact Walmart's coming out this week. What should we be watching for on that side?
Well, I think there are two different sectors there. In terms of Home Depot, that is in the consumer discretionary category. That's experienced some weakness recently to the point where it's now among the 4 worst performing sectors on a rolling 200-day basis. Walmart is in the consumer staples category because more of its earnings and revenues come from food rather than from more consumer discretionary items. We are expecting a positive movement in earnings, up about 4% year on year. So we're looking for 60 cents in earnings versus 58 cents last year. So probably get some good data, but certainly not enough to really be all that exciting.
And if we see some solid numbers from the staples like Walmart, what kind of an impact will that have on a possible rate cut and things like that, or will it have one at all?
I think that what that would do is offer some guidance to investors who have been rotating into the more defensive areas of the market, that it was a good trade. We've been seeing movement into, as you had said earlier, healthcare, consumer staples, energy. So companies like Lilly, Cardinal Health, and Amgen in the healthcare space, Valero Energy, Occidental Petroleum and Energy, and then Tyson, Coca-Cola, and Smucker in consumer staples, along with Walmart, we have rated buy at this point.
And just want to talk a little bit going into December. Some of the you talked about declines are not; these aren't all that out of line right now. And usually the rebounds heading into December are quite good historically.
Yes, they are. Because I looked and said, well, if we end up with a negative November, that could raise two questions. We had 6 months of continuous gains. So what does interrupting that 6 month mean? Well, typically it actually improves the follow-up month's performance, not only in terms of price change, but frequency of advance. And November is the best month of the year. December is the third best month. So the question is, what happens to December if November is down? And again, you end up seeing a sharp improvement in the average price change and an improvement of the frequency of advance from 75% to almost 90% of the time. So not a guarantee, but certainly some encouraging statistics.
Okay, and I'm bouncing a little, going back to government and the Fed. We're starting to see some numbers again. Any surprises? Are you expecting any surprises from any of them that are coming out this week or over the next little while?
Not really. We do think, as I mentioned, that the employment data will probably come in the mid to low 30,000 range. But then that's September, and we will be waiting for the October data fairly soon. But our belief is the Fed will cut rates when they meet in December, and instead of only one rate cut in 2026, as seen by the dot plots, we think that they'll end up with two, one in each half of next year.
Okay, we'll come back and visit that next year. Sam, thanks very much for joining us.
My pleasure, Roger. Thanks.
Sam Stovall is Chief Investment Strategist at CFRA Research.